The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's program brought to you by...
So she didn't inherit Grandpa's jawline, but there's no doubt she's family. It's your job to raise her, and it can be tough. Let's make it easier. With technology and automation, you can do more, like produce high-quality bales with way less effort. Built-in sensors can measure bale moisture and size, so you can monitor quality on the go and manage your fleet from your phone. Sit back and enjoy effortless operation. Discover an easier way to work.
Well, as we ended the week on Friday, we didn't necessarily get the headline I think some folks were hoping for in terms of U.S.-China relations in regards to soybeans. Beans were the downside leader with mixed activity to lower across the rest of the grains. Cattle finding a little bit of support ahead of the on-feed numbers. A lot to talk about here today on Market Talk. Brought to you by John Deere. Turn your hay or silage into consistent, dense bales with John Deere round balers. Precision features, integrated technology, and dependable performance. You can count on. Learn more at Deere.com. Joining us today for market analysis, Ted Seifert with Zaner Ag Hedge. Ted, how are you, buddy? It's good to talk to you and go over the week of the trade. Hope all is well.
Yeah, I'm doing well. You know, it's I'm glad to be getting to the end of this week. It's been a long few weeks for me, but yeah, no, it's good. You know, happy Friday.
Well, I want to ask you about the China soybean U.S. relations news. That seemed to be the big thing that traders were waiting on Friday, and I alluded to it in the open there. We didn't get the headline we wanted, and so we saw beans sell off a bit on Friday into the weekend. And, you know, I've been saying this for the last couple of days now. I've felt like the markets have been waiting on the next headline, and of course, you know, the headline Friday was the U.S.-China talks, and now moving forward, we'll have to discuss what the next headline is going to be. But in right now, soybeans, China, U.S., no deal. And so here we are again with a little bit of pressure, Ted.
You know, you look at what happened Wednesday and Thursday, you don't really get this feeling that the trade had super high expectations that there was going to be something really, really positive coming out of that phone call on Friday morning. And then there wasn't, right? The market did sell off on it, not down tremendously. I mean, down double digits. So, I mean, it was a fairly heavy day, but you know, we were under pressure leading into that. So, you know, you really don't get the feeling that there's a lot of optimism on a trade deal right now, Jesse. Even with the comments made by Bissett on Tuesday, which were really positive, we had a muted reaction. So, I think the trade is now starting to slide into a we'll believe it when we see it sort of mindset when it comes to Chinese soybean sales. It's got to show up on a daily wire or a weekly daily flash sale or a weekly export sales report. Then we can maybe start to become optimistic again. Right now, there's just really no reason for optimism in today's phone call, aside from the positive talk, progress made, so on and so forth. The next time they're meeting is going to be at APEC, which is October 31st and then November 1st. And it is a sidebar. It's not a specific sit down for trade. I mean, I'm sure it'll be discussed, but it's not a multi-day thing that they're going to be focused on. So, you know, I don't expect much from that. And then the next big trip, according to Trump's post on True Social on Friday, was next year, January or February. That's beyond our typical export window. You know, that's about the time where Brazil's harvesting their first seasons of soybeans. So, you know, chances are we completely miss our export window. And that's wild. You know, I mean, that would have a very profound impact on what our balance sheet looks like. That would have a very profound impact on soybean exports. That number's way too high if China's not going to buy. And maybe China does buy, maybe they have to. I mean, that's the theory, is that China can't avoid us completely. But even if they're avoiding us as much as possible, that's still going to have a pretty profound impact on our balance sheet. And there's not enough demand in the rest of the world to make up for it. So that's an issue. Now, I'm beginning to wonder, Jesse, if possibly let's say the second best thing for soybeans, obviously big, beautiful trade deal being the first one, but the second best thing for soybeans might just be Let's go back to the really big tariffs. You know, China implying a 130% tariff on our soybeans. Because what that would do, Jesse, is that would push the premiums of Brazil up pretty significantly to the point where when you put that together with the strength in the real, it might open up the opportunity for arbitrage for Brazil to be buying our soybeans and then turning around and selling them to China. It's not good. That's not the way we want to see that. When you add in shipping costs and everything like that, it means that our soybeans would have to be really cheap for that to work, even with that 130% tariff or whatever China would have on us. Um, but that might be the only way we're really doing any reasonable business with China. And again, it would have to come at a cost for us, meaning low price soybeans. So I don't know. It's just not a good feeling here to end the week. You know, on the other side of that, though, Jesse,
Mm-hmm.
we're going through yields, right? We're
Yeah.
waiting for more information for that. I mean, that is a big thing for. We had the driest August since driest August since 2013. So generally speaking, I mean, that should have a pretty profound impact on soybean production. I mean, soybeans are an August crop. And yeah, we had good subsoil moisture going into August, and yeah, we had cooler temps in August. You know, so which by the way is actually pretty similar to 13. And in 13, we were all kind of surprised when yields ended up being pretty close to trend line, given that very, very dry August. I wonder if this is going to be one of those years, but we're worried about that soybean yield. So you've got conflicting factors, and that's I think why the soybeans in the last few days have gravitated right back into this cluster of major moving averages between the 50, 100, and 200. It's about an 8 cent range. We spent a lot of time in the beginning of the month trading in that range. We're back to it, and I think you're right. We're waiting for more answers. You know,
Mm-hmm.
I don't know if we're going to get a new headline on trade, but you know, we're waiting to see a daily flash sale or a weekly sale or something. And in the meantime, waiting to get more info on yields.
Well, let's think about maybe some other headlines here. And you brought up to me shipping fees, and I want to talk about that, but I want to throw another one at you first. There's talk of this potential bridge payment for farmers amid the farm economy right now. Secretary Rollins indicated that those conversations are ongoing on my Agriculture of America program on Monday. Senator Roger Marshall of Kansas on Friday's AOA said the same thing. We could see news maybe even this upcoming week. Secretary Rollins also said something about it in the Financial Times this week. So, could a bridge payment of sorts, could that be something that gives some sort of life into the commodity markets, Ted?
Oof. Okay. First of all, I'm going to say I think something like that is not only justified, but I think at this point absolutely necessary. Any lack of progress or any real progress happening in that phone call on Friday morning with Trump and Xi really highlights the need for something like this. Obviously, input costs are very, very high, and we've lost our main export customer in soybeans. I'm not a big fan of government intervention in markets.
No.
However, when you have a government effect negatively affecting markets, then I'm okay with doing something to positively affect markets. Now, your real question was though, would that have an effect on markets? And unfortunately, yes, it would, but it's not the positive effect that I think we're hoping for. It would be money sent to farmers. Again, I think that is justified and necessary at this point, given the trade issues. But markets do what they do best. They seek efficiency. They seek to provide a function. They seek out to meet a goal, and the goal in the soybean market at the moment, as we wait to see more about yields. But if yields aren't terribly lower, well, we're going to try to find more demand. We're going to try to put beans on sale, and if you're adding payments to farmers, that means beans could actually go lower and really kind of price that payment in. Now, that might not be a terrible thing from a crop insurance perspective, but it'll be a huge outlay for the U.S. government. So I don't think that would actually have a very positive effect on markets. I'm worried it would have a negative effect on markets longer term. Direct payments usually do, because again, the soybean market will try to price in that payment, which means they'll discount the amount of that payment. For corn, I don't know. I don't know what they would do for corn. I don't really feel like we are very negatively affected by trade for corn. But the big thing there is that input costs are so high, right? And so our break evens for corn are historically high, and we just don't have good prices right now. So I do think a direct payment in corn would be very helpful. I think is needed, right? But I'm not sure the same justification is there. I'm very curious to see what happens with that.
Ted Seifert, Zaner Ag Hedge, joining us here today for market analysis on Market Talk, brought to you by John Deere. Let's talk about this shipping fee news. You brought this up to me before we went on the air, that it's something that, we talked about it a lot several months ago, and then I haven't heard much about it in the
Right.
news cycle. Could that be the next headline that has an impact here in the markets, Ted?
Yeah, and that's not something that, like you said, we've really heard a whole lot about recently, but we're kind of coming up on that pretty quickly. It's supposed to go into place on October 14th. And what it is, just to refresh everybody's memory, there will be a port tax for any Chinese flagged vessels, which again at the moment isn't a big deal because we're not really doing business with China. But it's also a tariff on any Chinese built vessels, which, oh boy, yeah, that could mean something for our other export partners, right? So that could be an issue, and it also just really compounds the current tariff structure that China has on us. It just adds to that. I mean, it's another way of kind of adding tariffs or taxes to tariffs, and just making more U.S. beans more expensive to China. So it's an even further uphill battle, it seems, Jesse. Uh, and yeah, I mean, if nothing changes with that in the next 3 weeks or so, it further deepens the troubles that we're having with our export window of opportunity, and any sort of potential that we might start doing business with China anytime soon.
So thinking about all of this, and you brought up yields earlier, we're getting some early results in. We'll see more here in the next several weeks. How much of the top end was taken off with diseases, for instance, like southern rust, et cetera, et cetera. So there's gonna be a lot of moving parts here in these
Yeah.
grain markets. How do we manage our risk in this window, Ted? And I know that's a double-edged sword, I think, and there's a lot of ways you can look at it, but you know, no risk management is not good risk management, I would say.
Yeah, I would agree. I would agree. I am going to say the good news there for corn is that, we're 30 cents off of lows. And, you know, yes, our yield expectations have come down pretty dramatically since the beginning of August. The USDA's started to trim the yield, but, I think most of us believe that that yield will get trimmed further. The question really is how much. But in my mind, Jesse, this sort of unfortunate thing here is I think there's a lot of demand on the balance sheet that might not actually be there. I mean, the USDA is looking for at or new records or close to record for every line item that we have on the balance sheet. And the only one that I think is really justified right now is exports. However, if you look at export sales the last couple of weeks for corn, they've really kind of slowed down. And with the big crop in Brazil, the USDA just raised that, but CONAB is still, or CONABI is still looking for a much higher number than what the USDA currently is, which is an atypical relationship. Usually, the USDA is above CONABI, which suggests that the USDA might still be 6 or 7 million metric tons too low on that Brazilian or Brazilian corn crop. And at some point, they're going to start shipping corn a lot more aggressively than they have been. They've been focused on beans. Beans have been really clogging their ports. The Brazilian farmer hasn't loved the prices of corn, but at some point they have to start to move that corn in order to barter for inputs for their upcoming growing season, which is coming up really fast, actually. And so when that corn starts to move, it will really contend with us as far as our traditional export window for corn. So you wonder if a lot of these sales for U.S. corn have been sort of front loaded, not necessarily front loaded because of impending tariffs or things like that, but just maybe our export window has shifted forward a little bit, just based on what's the seasonality of what's happened in Brazil. And if that is the case, then the USDA might not have to raise exports any further. And in the meantime, you look at the feed and residual number, which I think is maybe 200 million bushels too high. We don't have the animals out there, Jesse, and really, so that means it's residual. And I don't know. To me, that's the USDA's built-in function of, well, if we're lowering yield, then here's what else we can lower to kind of offset that to some extent. And I do think ethanol is justified for now, but again, there too, I worry about what that might look like a few months from now. So I think if you do take 4 bushel an acre off the soybean crop and put it at an 82.5 roughly, I still think you're pretty close to a 2 billion bushel carryover. And if that's the case, I still think there's a lot of bushels that are going to be sold during harvest. We have not really gotten into the thick of harvest quite yet. I mean, we're just getting into it. And I think guys are really undersold. We didn't have these typical summer weather rallies that serve a function to get guys filled on their resting orders, their target orders. So you're going into a harvest where guys are undersold. Yeah, it's a lighter crop. How much lighter is the question? But if there's still a whole lot of bushels that are getting sold at harvest, that's still going to be a lot of pressure on the markets. I'm worried that we might still make new lows in corn. So I do think that doing something here is justified. I am a fan of reownership strategies. I'm not really employing that very much at the moment because we've bounced off the lows as well as we had. I would do that more aggressively if we get back down towards lows. But for corn, I think you use the strength that we've seen. I'm hopeful that there's more strength to come based on lower yields. But given the trade action in the last or price action in the last 3 days or so, I'm not feeling nearly as confident about that as I was earlier in the week. And then for soybeans, man, you can make a case for soybeans to go $2 higher or $2 lower, depending on what happens with yield and what happens with trade. If we were to have gotten a trade deal today, I could see us, being sharply higher. You can almost justify $12 beans if China were to come in and buy their normal amount. But if that's not going to happen and yields don't drop as much as some people are expecting, well, then you can talk about soybeans well below $10, maybe in the low nines, maybe even in the upper eights. So you've got a tremendous amount of risk on both sides of this market, Jesse. One way or another, locking in a floor, either buying puts or selling cash, and then maybe owning a call in case that trade deal does happen at some point. That's a synthetic put. I like that way. I do want to leave upside potential open because if yields are down and we do start doing business with China, we could have a very tight balance sheet very quickly, But on the other hand, there's a tremendous amount of risk that China does avoid us as much as possible. And basically we have to put beans on sale to try to entice them to buy and overcome the tariff issue that they still have in place on us, which is what, 30%.
Mm-hmm. Final few minutes here, Ted. One of my favorite things to talk to you about is the economy and the Fed. We got the rate cut Wednesday, 25 basis points as expected. What's your thoughts on what that means for the broader markets, whether it's stocks, commodities, livestock, you name it, the dollar? What's your feeling a couple days post that rate cut that was expected?
Yeah, I think for what it was very, very much expected. So, it was priced in at a 99%. The Fed funds rate had priced it at a 99% likelihood that would happen. So it did. So it's not a big shock to the market. I think overall, stock market looks really good. I'm concerned about the economy as a whole headed into the fall and winter months. I'm worried that we see a bigger slide. I'm worried that Fed may have taken too long to really lower rates. I could have maybe made an argument for a half a point reduction, but we'll see.
Mm-hmm.
I think the big thing for me is that, hey, look, when we talk about input costs, and raising corn and soybeans, and a lot of those input costs right now are interest rates. So that is helpful for the producer. But again, I worry that maybe it's a little bit too little, a little bit too late. I would have liked to see a deeper cut. At the same time, we worry about inflation, and this is the tightrope that the Fed is walking. And again, bringing that back to the producer level, we see inflation still very apparent when it comes to inputs. Now, part of that is because of global conflict and where we get a lot of our inputs from on the nitrogen and the fert side. So, there's a lot of factors at play that are making things very difficult for the American producer right now. Lower interest rates would help.
Ted, always appreciate it. Anything final you would add or reiterate for folks today?
Just to touch on livestock really quickly. Nice recovery at the end of the week after a pretty decent correction. One of the bigger corrections we've seen in really since, if you look at October feeder cattle, we've not had a correction like this in the lifetime of the contract. The question everybody wants to know is it over? And I'm not so sure it is. It goes back to my economy concerns. I think the Fed lowering a quarter point might not have been enough, but also does it's sort of an admission of, we're a little bit worried about how things are going into the fall and the winter months. And if you were to see a bit of a pullback in the economy, you could have a speculative run for the doors in the cattle complex, as well as you've got a lot of producers out there that have gotten away from hedging just because margin calls are a lot, and when you're taking swings like this, right? I mean, so I think there's a lot of very willing sellers from a profit taking and a get me out of my speculative position, but also a lot of producer selling. So I do worry that there's downside potential there. I think hedging cattle on any bounces like we've had Thursday and Friday, it's a really good idea.
Ted, if folks want to reach out to you, have a conversation and more there at Zaner Ag Hedge, how can they get in touch?
Sure thing. You can reach me directly at 312-277-0113. Aside from that, you can find us on the web at www.zaner.com. You can sign up for my afternoon commentary, which is a 3 or 5 to 7 minute recording that you can call in and listen to at your leisure. Also, sign up for our new newsletter, which is coming from our new chief market analyst, Karen Braun. It's really, really good. I highly recommend that. And also, if you're on the Twitter or the X platform, I'm at the Ted Spread.
Always enjoy the conversation. Ted Seifert, Zaner Ag Hedge, joining us here today on Market Talk, brought to you by John Deere. Ted, good to hear from you again, my friend, and we'll look forward to talking again real soon.
Yeah, awesome. Thanks for having me on, Jesse. Always a pleasure, man.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.